We're ready.
Good afternoon, everyone. Co-Chair Senator Jim Rosapap and myself would like to welcome everyone to the Affordability Committee meeting on Tuesday, November 7th. This afternoon, we will have a fiscal briefing by Department of Legislative Services. Before starting, on the House side, we would like to acknowledge that we have the Speaker of the House, Speaker Jones, and also Chair Barnes of the House Appropriations Committee, and also Chair Atterbury of the Ways and Means Committee, and would like it to open up to see if they have any remarks at this time. Thank you very much, Speaker Jones, Chair Barnes, and Chair Atterbury. Senator Rosapap, if you'd like to recognize anyone on your side.
Absolutely. We have President Ferguson with us and Budget and Tax Chair Guy Gadot. Either of you guys like to say anything? Okay, I think we're ready to rock and roll.
Great. Thank you very much, Senator Rosapap. This afternoon, we're going to be hearing several presentations from the Department of Legislative Services that's listed on the agenda. If the members could do this, we'll go through the entire briefing presentation. At the end, we'll take questions. Senator Rosapap will recognize the members of the State Senate, and I'll recognize members of the House. We can start with the overview by Mr. David Reeds.
Thank you, Mr. Chairman, and good afternoon, everyone. So we're going to do an overview of the various fiscal issues, the revenues and economy, and health of the general fund, the health of the transportation trust fund, and a look at sort of what's affordable in terms of the capital budget. I would just say to you that I think you'll see that the theme of the day is that the commitments and aspirations the state has, and really all three of those important areas, seem to be greater than the existing resources available. Some of those issues are more acute in the very near term. Others, you have a couple of years to kind of think about how to resolve. But I think that's kind of the primary challenge going forward. We're going to kick it off with Teresa Chizinski, who's going to talk about the economy and the revenue outlook.
Thank you, Dave. And if we could share the document, great, Maureen. I'm going to start with the economy, and then there's a couple pages about the economy, then there'll be a couple pages about revenues. And we'll start here on page 1. There's been some attention recently about how the Maryland economy has been performing relative to the U.S. economy, as well as relative to our neighbors. Over the summer, the administration highlighted some data showing that the Maryland economy had essentially not grown at all in the previous 4 years. And if you looked at inflation-adjusted gross domestic product, or GDP, which is the broadest measure of economic activity, that was true. The data showed that between 2018 and 2022, the Maryland economy had grown just 0.2%, which is effectively no growth at all. But as often happens with economic data, there has been a revision. This data was revised at the end of September. There's revisions every year, but this year happened to be a once every 5-year comprehensive revision, so it was pretty large. It affected all the states and the US. And what the tables on page 1 are doing are comparing the original data to the revised data. And it does change the picture a little bit for Maryland. On the left-hand side of this page is total inflation-adjusted GDP. Again, we're comparing calendar 22 to calendar 2018. And Maryland's growth was revised up from that 0.2% growth to 2.4%. And our rank went from 44th to 40th. We still lag behind growth in, say, neighboring Virginia, as well as the US, but we now outpace not only West Virginia, which was already true, but also Pennsylvania. Another way to look at this, and maybe the better way to look at it when you're comparing across states and across this amount of time, is to adjust for population. And so the table on the right side of the page is the same data, but per capita. And that's because all things being equal, we would expect a state that has fast-growing population to also have fast-growing economic growth. And in fact, if you look at the total growth over this time period of GDP, the number one state is Idaho. But Idaho is also the fastest growing state in the country over this time period. And on a per capita basis, their rank drops from 1 down to 12th. And actually the fastest growing state on a per capita basis was California. But it didn't have a whole lot of an impact on Maryland or on Maryland's rank. The data on a per capita basis was revised up from a minus 0.2% to 2%, but our rank barely changed at all. Under the revised column, for total, we're ranked 40th. On a per capita basis, we're ranked 39th. But it did make a big difference to two of our neighboring states, and that's DC, the District of Columbia, and Delaware. DC lost population over this time period, and so their per capita growth rate is considerably stronger than their total growth rate, and their rank went up to 17th. Delaware's the opposite. Delaware is a fairly fast-growing state. They had the 9th highest population growth, so their per capita growth rate is slower, and their rank dropped to 43. So on a per capita basis, Maryland's performance actually outpaces not only West Virginia and Pennsylvania, but also Delaware. Now, the point here isn't to argue that the Maryland economy is doing great and growing like gangbusters, because clearly it's not, and we rank in the lower quarter of states. But it has changed the picture a bit, this revised data. Another way to look at where Maryland is or is not lagging would be in the labor market, and that's the chart on page 2. And this chart seeks to answer a fairly simple question. At the beginning of the pandemic in early 2020, every state lost jobs, lots of jobs, in the first couple of months. And the chart is trying to answer the question, have we gotten back to the level of jobs we had in the state right when the pandemic was beginning, back in February of 2020? And so the change here is showing you, well, the answer to that question, I'll give it away, is no, we have not. We're actually only one of 13 states that has yet to get back to the level of employment that we had back in February 2020. The US economy got to that point in June of last year. Virginia got to that point in August of last year. Among our neighboring states, DC and West Virginia also have not recovered the jobs that they lost during the pandemic. And you can see on the chart, in total, we're still down 11,300 jobs as of September, which is the most recently available data on employment. And we've made a lot of progress. Maryland lost 393,000 jobs in the first months of the pandemic. So I don't want to give the impression that we don't have job growth. We have a lot of job growth, but we just have not gotten back to the level we had when the pandemic began. And the chart kind of breaks this down by some major industry categories. The industries that are most lagging are also the ones that were most impacted by the pandemic. And first and foremost is leisure and hospitality services, which is the second one from the bottom. It's a category that is actually dominated by restaurants and various kinds of bars and other kinds of food service facilities. It also includes hotels, various recreation entertainment facilities, everything from bowling alleys to museums to the casinos are in this category. And obviously, a lot of those facilities were closed in the first months of the pandemic. And so they lost a lot of jobs, and they're still down by about 25,000 jobs as of September. Also impacted in a similar way was retail trade. The retail and wholesale trade, that category is almost entirely retail trade, and that is still behind where it was in February of 2020. Some of the other negatives, though, like manufacturing and information, for example, includes the telecommunications companies like Verizon, and parts of financial activities have been on a kind of a long-term trajectory of lower employment in the state. And so the fact that they're still down from February 20 is probably more a reflection of those long-term trends than anything specific to the pandemic and the recession that followed. In addition, a lot of financial activities is tied to the real estate market, so it's probably experiencing some weakness because of the run-up in mortgage rates and the decline in home sales. On the plus side, the big plus in percentage terms was transportation, warehousing, and utilities. And that's really all about warehousing, and warehousing includes the big distribution facilities for all the online companies, Amazon, Wayfair, et cetera. So it's not at all surprising to see that that is up big from where it was in February 2020 when the pandemic began. We've also experienced really strong growth in the federal government. You can see that's up 9.5%. We've seen some growth in the private sector and professional and business services. That's where a lot of government contractors are. So if we move onto the next page and look not only now at employment, but also bringing in wage and salary income. Wage and salary income is a really key economic statistic. It's really important for the revenue forecast. And so what this chart does is kind of in two pieces. The top half is looking at the year-to-date growth so far in calendar 2023 for Maryland, Virginia, and the US, for employment on the left side and wage and salary income on the right. This is quarterly data. And then the bottom half of the chart is the forecast. So for quarterly data, we have employment data through the third quarter of 2023. And you notice that across the board, employment growth has slowed. Employment growth in 2023 is considerably slower than it was in 2022. And that's not at all surprising. Growth in 2022 is really reflection of rebounding from that first year of the pandemic. And that pace of growth was never sustainable. So we fully expected that to slow down. We've also seen some slowing employment growth as 2023 has progressed. And again, not entirely surprising given the Federal Reserve has been raising interest rates pretty aggressively. Their whole goal here is to slow down the economy. And we are seeing slower employment growth. Maryland does lag the US and Virginia in terms of employment growth. But on the wage and salary side, we've actually seen quite strong wage and salary growth here. And Maryland is actually even running slightly ahead of Virginia in the first half of 2023. We only have data through the first 2 quarters for the states on wage and salary income. I will say, as with the GDP data, all of this data is subject to revision, both the employment and the wage and salary income data. In terms of the forecast, this is the forecast for calendar 23 through calendar 2029. Again, employment on the left, wage and salary income on the right. The BRE forecast for Maryland comes from their September revenue revision. And then as a point of comparison, I grabbed the Moody's Analytics forecast for Virginia and DC. And what's really, Virginia and the US. What's really striking is how the forecasts converge. Employment growth slows to less than a 0.5%, even for the US economy as a whole. Maryland, a little bit slower growth than that per the BRE forecast. Wage income also slows to a little bit less than 4%. Again, the BRE's forecast of Maryland is a little bit below that, but really all in the same ballpark. This is a baseline forecast. This is not the result of a recession. This is really being driven by demographics, by slow population growth and the aging population. We know that baby boomers have been retiring, reaching the age of retirement and leaving the labor force. Next year, the youngest baby boomers will turn 60. So that's a process that's ongoing. And that's what's really driving the slowdown in employment growth. On top of that, of course, there could be a recession over this time period. That's not factored in here, but it could happen. We also, in the near term, could see a government shutdown as soon as a week from Friday. So there are some other risks on top of this forecast, but this is the baseline forecast for the Maryland economy and the US and Virginia economies. So if we turn to the next page and we'll move on to the general fund revenues, and we're going to start with the general fund closeout for fiscal 2023. Fiscal 2023 ended June 30th, and this is comparing the actual revenues to the estimate, as well as comparing it to fiscal 2022. In total, general fund revenues are estimated to be, were $23.7 billion in fiscal 23 and fell 1.5% from fiscal 22. But there was a big $800 million distribution or transfer to the Blueprint Fund in 2023. This is a one-time transfer. And so it makes more sense to focus on ongoing revenues. And they were up 1.7% in fiscal 23, but the estimate had been for 2.3% growth. In total, general fund revenues were below the estimate by $39 million. Ongoing revenues were down by $139 million. And that difference is accounted for by the volatility adjustment, which you can see in the estimate was a negative $100 million. That amount, that $100 million was set in statute. And the volatility adjustment here was really kind of doing exactly what it's designed to do, which is mitigating the impact from an underattainment in specifically non-withholding personal income tax revenue. And you can see the personal income tax was really the source of weakness here. It was under the estimate by $330 million and fell 0.6%. And the next chart will have a little bit more detail on the personal income tax. Can we go back to the previous chart for a second? Wasn't quite finished. Among the major revenue sources, the corporate was above the estimate, and so was the lottery. The sales tax was behind by just a little bit. Among everything else, we had very large overattainment in interest earnings, reflecting the rise in interest rates over the past year. There was strong overattainment in the estate and inheritance taxes. Once again, the insurance premium tax was over the estimate. There was some underattainment in miscellaneous revenues and the tobacco tax. And then there was a significant overattainment in the business franchise taxes related to corporate filing fees. And this was entirely due to a piece of legislation that ended up not costing the state as much had been forecasted. The legislation itself goes all the way back to 2016. It sets up a program to incentivize businesses to offer a retirement savings plan to their employees. The incentive is the waiving of corporate filing fees. So it was expected to cost the general fund a significant amount of money as businesses got to waive their corporate filing fees. Although the legislation was passed in 2016, the program only began in 2023, and the uptake was just considerably less than expected, at least initially here in this first year. that may grow as time goes on. So anyway, that effect of that program and the slow sign up meant that they're added about $50 million to the overattainment in general fund revenues here in fiscal 2023. And it also increased the out year estimate as well, as the BRE adjusted their assumptions about what that legislation was going to cost. Now we can move on to the next page and talk about the income tax. So this chart provides some more detail on the fiscal 23 closeout for the income tax. This is total state and local income tax revenues. At this level of gross receipts and net receipts, we cannot distinguish between how much is state and how much is local, so that's why it's combined. And you can see the various components of the personal income tax. Far and away, the biggest is income tax withholding, and this is the one bright spot. It was over the estimate by $171 million. It grew 5.5%, a whole percentage point faster than expected. But it could not offset the underattainment and everything else in those non-withholding payments, which is to say quarterly estimated payments, which were down 9.1%. This is a mix of tax year 22 and tax year 23 payments, but it's mostly weighted towards tax year 22 payments. And then even more important, the underattainment in final payments with returns, again, related to tax year 2022 returns, falling 20.7%. On the flip side of that, refunds came in over the estimate by almost $100 million, grew 10.6%. So the BRE fully expected this to happen. You can see their estimated growth rates for everything in the second to the column second from the right. So they expected payments for tax year 22 to fall relative to fiscal 22 when they were tax year 21 returns. The question was always the magnitude, and clearly the magnitude was much bigger than they had anticipated. So this is the second year in a row that non-withholding income tax payments has had a big effect on the general fund revenue closeout. In 2022, it resulted in a huge overattainment. In 2023, it's the biggest source of underattainment. So now we can move on to the general fund forecast on the next page. As you're aware, the BRE issued a new forecast in September, and this chart is comparing their September forecast to their March forecast for fiscal 2024, also comparing it to fiscal 2023, and then we show you the fiscal 2025 estimate. In total, the BRE wrote down revenues by just $14 million. In fiscal 2024, looking for growth of 3.8% over fiscal 23. But again, fiscal 23 had that one-time only transfer to the Blueprint Fund. Ongoing revenues are forecasted to grow just 0.9%. In fiscal 25, the BRE is projecting growth of just a little over 2%. And the revisions here mostly follow what happened in fiscal 23. So you see a big downward revision to the personal income tax and upward revisions in a bunch of other places. I'll call your attention to the lottery, and in particular, the 17% drop in general fund lottery revenues in fiscal 2025. Over the last several years, there's been an increasing share of lottery revenues that are diverted from the general fund to a variety of other purposes. In total, these special fund distributions are set to increase pretty significantly. They're about $39 million in fiscal 24, and that's going to jump to about $129 million in fiscal 25, and it keep growing. By the time you get to fiscal 2029, it's going to be about $185 million. Now, a lot of this is related to the redevelopment of the football and baseball stadiums in Baltimore. There's also money going for the development via the Stadium Authority for other kinds of entertainment and sports facilities in the states. There's also an effort to redevelop the Blue Line corridor. And this money, lottery money, is also being used to pay for bus rapid transit grants in the Department of Transportation. But that's the story behind the big drop in general fund lottery revenues. I also want to call your attention to the volatility adjustment. You remember in fiscal 23, it was $100 million, and it really mitigated the underattainment from the personal income tax, at least partially. Here in fiscal 24, it's $120 million. It doesn't change because the amount is set in statute. In fiscal 25, it'll be $140 million. That number 2 is set in statute. But beginning in 2026, the volatility adjustment is being driven by the calculation, and the calculation of how to calculate it is set out in statute. And so for the first time in 26, it's not going to be a fixed number. It's going to be the result of a calculation. And that takes us to the next chart, which will be the last chart here about revenues. And this is a graph we actually presented last year to the Spending Affordability Committee. and we've updated it here. This is non-withholding income tax revenue as a percent of total general fund revenues. Again, non-withholding income tax revenue, that's quarterly estimated payments, it's payments with returns. And the solid blue line here is the actual going back to fiscal 2011. And then we have some forecasts that we'll get to in a second. Obviously, it moves around a lot. It tends to fluctuate around the business cycle. So you can see, if you look at 2011, all the way on the left-hand side of the chart, that's coming out of the Great Recession, big stock market crash. So as a share of general fund revenues, it was quite low, kind of steadily increased pre-pandemic, and then really shot up in 2021 and 2022, where it got to over 20% of general fund revenues. And that was in fiscal 22 when we had a big overattainment from that. The dashed green line is the BRE's March forecast of this percent. So again, non-withholding as a percent of total general fund revenues. They expected it to come down to about 19%, but the actual was about 17.8%. That's the underattainment in fiscal 2023. It also is influenced by the fact that a lot of other general fund revenues did very well in 2023. In March, the BRE expected this to trend down slowly, but stay well above the 10-year average. And in September, they also have it coming down slowly, but starting from a lower place in the fiscal 23 actual. But again, staying a bit above the 10-year average, but getting much closer to the 10-year average. And this is important because this is a key factor, the key factor in the calculation of the volatility adjustment. The concept here and the purpose of the volatility adjustment was to say, when we are experiencing a lot of non-withholding income tax revenue, because we know it's very volatile, we compare this percent, how much is our general fund revenue coming from this source, to a 10-year average. And the higher it is relative to that 10-year average, the bigger the volatility adjustment. That's the way the calculation works. And a volatility adjustment, remember, is a negative number. It's reducing general fund revenues to get to a bottom line general fund revenue that feeds into the budget process. So what has happened between the March forecast and the September forecast is that percent in the forecast has come down quite a bit. And if there's the difference between the non-withholding percentage and the 10-year average shrinks, then the volatility adjustment gets smaller. And because it's a deduction from revenue, if it gets smaller, it increases general fund revenues. And that is what happened, that's happening in the forecast beginning in fiscal 26. So to put some numbers on that, in fiscal 26, when the BRE recalculated the volatility adjustment in September, it added $233 million to the general fund revenue estimate for fiscal 2026. For ongoing revenues, the BRE had written down general fund revenues in fiscal 26 by $267 million, most of that coming out of the income tax. But the volatility adjustment changed, added $233 million. So the net impact of all this on fiscal 26 revenue estimate was just a decline of $34 million. And that, again, as in 23, is showing the volatility adjustment kind of doing what we wanted to do, which is to protect or mitigate to some degree the risk of this volatile revenue source. And you can't mitigate it entirely, but you can do this. The purpose of this is to at least partially mitigate the impact of this revenue source, which is volatile, but also quite large, from really swinging the general fund revenues that we're using to budget and to deal with the budget process. And so it also has like a similar effect in 27, 28 as you go forward. So that, I think, concludes my section on the economy and the revenues.
Yep. So Tanya Zimmerman is going to talk to you about the kind of operating budget outlook for fiscal 24 and 25 now.
Hey, thank you. It's Tanya Zimmerman. So I'm starting here with some additional information on the fiscal 2023 closeout. The reversions totaled $381 million, which was significantly higher than what was expected during the 2023 session. About $215 million of the reversions were in the Department of Health. That includes a number of different areas. So there was about $64 million of that was related to provider reimbursements for fiscal 2022 bills to be paid in fiscal 2023 that were kind of less than expected. That's actually less than the anticipated reversion, which was about $80 million. There's also a number of other areas of reversion. So there was about $60 million for residential and other substance use disorder services and inpatient behavioral health. Some of that was slower than expected growth, but some of that was also because we received a federal waiver that was not anticipated in the budget development. So some of those costs were just eligible to be paid for with federal funds. There were a number of other areas that programs were slow to be implemented. That includes $35 million for crisis stabilization services. The regulations are still in development. It includes $8 million for the behavioral health infrastructure investments that were provided through a deficiency appropriation, and also $2.5 million for the Sheila Hickson Behavioral Health Services Matching Grant Program, which did not get implemented as expected in that year. About over $30 million of the reversions are in error. That includes about $16 million for the child care stabilization funds. There's about $10 million of legislative scholarships that were reverted in error. If you turn, I guess, 2 slides ahead. So the next portion I'll discuss is related to our estimate of the fiscal 2024 deficiency appropriations. That results in a net increase in general fund spending of about $86.6 million. And that's about $168 million of increases. The largest area of increase is in Medicaid and behavioral health. About 40 million of that is for fiscal 2023 bills for which there was insufficient appropriation. They have 12 months to bill, so there's always some amount of bills paid in the prior year. Usually you're paying with those from that appropriation. The appropriation was insufficient. And then some additional shortfalls due to higher than expected caseloads. There's also about $40 million of additional fiscal 2023 expenses. The largest of those, over $32 million, is in the Department of Public Safety and Correctional Services for inmate medical contracts. That spending is both for regular contract costs and also related to settlement of a contract dispute. These increases are partially offset by vacancy savings due to the current vacancy situation, which you'll hear a little more about later in the presentation. You go to the next slide. So this is a chart that shows information about the fiscal 2025 estimated spending. In total, the general fund spending is expected to decrease by about $587 million. The largest area of increase is state agency spending, which I'll detail a little bit more in a moment. Local aid increases by about $156 million. That's really driven by retirement costs, in particular teacher and librarian retirement costs. Aside from those costs, there's a net decrease in local aid. These increases are more than offset by $1 billion of one-time funding for legislative additions. However, that includes $400 million for the additional deposit into the Blueprint Fund, $100 million for additional transportation projects, and about $369 million of PAYGO funds, which included funds that were kind of swapping general obligation bonds with general funds. If you go to the next slide, this provides additional information on the areas of growth in the state agency budget. Over a quarter of that is anticipated compensation changes. That includes anticipated 2% salary increase for state employees and increments, as well as the 5% increase for those in the SLEOLA bargaining unit. There's about 17% of that's related to kind of pension and other personnel costs. That includes about $14.5 million for the new the anticipated family contributions for state employees. About 50 million of the increase is due to the expected filling of current vacant positions. The next largest growth is in provider reimbursements for the Developmental Disabilities Administration and non-Medicaid behavioral health. That's really driven by the Developmental Disabilities Administration due to provider reimbursements and other kind of expansions of services. If you go to the next slide, This is kind of the last slide here on fiscal 2025 itself. Even with the decrease in general fund spending that's anticipated, the cash balance is expected to be negative of about $413 million. That is after a transfer to the general fund from the rainy day fund of about $625 million, which is the amount above 10% of the rainy day fund. The structural balance shortfall is a little smaller at about $322 million. And I'll turn it over to Dave to talk more about the structural issues.
All right, so now we're turning to looking at the general fund over sort of a longer term. Our forecast for the out years basically is assuming we keep doing all the things the state is committed to doing, implementing all the legislation that's been enacted, and then we assume salary increases for state employees, 2% a year plus increments in each of the out years, and kind of key assumptions. So this chart is looking at the outlook through fiscal 29. It assumes in all the years that we keep 10% in the rainy day fund, and I'll talk more about that assumption in a little bit. The blue bars show you the cash outlook for the general fund, and the line is the structural outlook. And the fiscal 25 numbers match the numbers Tanya just talked about. And then you can see the cash outlook gets worse, about $1 billion in 26 and about almost that much in 27. And then it gets substantially worse, as does the structural outlook in 28 and 29. The primary reason for the big jump in 28 is education costs get borne by the general fund to a much greater degree than in prior years. Because one, the education implementation costs continue to grow as we implement Kerwin, but two, because we've been using fund balance in the blueprint fund to support those implementation, and we run out of that money by fiscal 28. So the bottom line is by fiscal 29, we only have revenues to cover about 93% of the projected spending. So there's a significant structural challenge. This is one of the larger challenges we've seen in some time, going back to the 2016 or so. Let's go to the next slide. So just to show you what's driving the growth. So this is looking at fiscal 29, our estimates, versus fiscal 25. And half of that growth, as I mentioned, is in the education aid area. The other major drivers are personnel, largely because of our assumptions about COLAs and increments in each year. And then entitlements. And the entitlement growth is actually not so much caseload driven. It's more that we assume modest provider rate increases each year, again, generally in the 2% range each year. And that adds up to a lot of money over 4 years. So that's sort of what's driving the growth, those three areas. Let's go to the next slide. So I wanted to take a little closer look at the education costs and the Kerwin implementation. So the stacked bars here are essentially the Kerwin implementation costs each year. And as you would expect, as we roll the program out, those costs continue to grow. The different colored parts of the stacked bars show you how we're paying for it in fiscal 24, and then what we've assumed will be the funding mechanisms in the future years. The blue part of the bars is actually the Blueprint Fund ongoing revenues. So this is the ongoing revenues from casinos, from sports gaming, and from some of the sales tax gets devoted to the Blueprint Fund. And you can see that grows each year, but it's a fairly small amount, certainly doesn't keep pace with the growth in planned spending. The yellow part of the bars show you the use of the fund balance in the Blueprint Fund. At the end of fiscal 24, we expect to have about $2.6 billion in the Blueprint Fund. And that helps to pay for the implementation in 25, 26, and 27. But then you can see it starts to happen at the end of fiscal 27 and then much greater degree in fiscal 28. We have to turn to the green bars, the general funds, to supplement the Blueprint Fund as we've exhausted the Blueprint surplus. So what's really happening is that the general fund is covering both the growth and costs in fiscal 28 and then again in 29, but also backfilling for what was supported with Blueprint Fund balance in 26 and 27. So that's sort of the big picture on what's driving the education costs. Let's look at the next slide. All right, so some words about sort of the budget challenge. I mean, I think a lot of this is obvious. The preferred solution is obviously a structural solution because you have an ongoing budget problem. It's not kind of a one-time situation. So structural options would be reducing some of our ongoing spending commitments and or increasing revenues. Now, just to give you a sense of magnitude of the challenge, if you were to try to solve that whole fiscal 29 challenge with revenues, it would be the equivalent of increasing income tax revenues by 12% or the sales tax revenues that go to the general fund by about 30%. That's a very significant challenge and one of the bigger ones we've seen recently. Now, in the short term, there are some other strategies that could be used to help balance the budget. One is that the governor's capital improvement plan last year assumed a substantial amount of general funds would support capital projects in fiscal 25 through 29. And that's what our baseline has assumed. We followed the administration's assumptions. Some of those costs could be shifted to bonds, which would provide some general fund relief in the short term. The other short-term strategies, as I mentioned before, our forecast left 10% in the rainy day fund. That equates to $2.5 billion. So there certainly would be opportunities to use some of the money in the rainy day fund to help mitigate the short-term problem, but that does nothing to help with your structural solution. The other downside of using too much rainy day funds when you're not in a rainy day is that if we get a recession at some point in this forecast period, then you don't have that rainy day fund to help mitigate the impact of a recession, and your budget challenge becomes that much more challenging. Let's go to the next slide. So this just looks at if you went to the sort of the extreme, use all of the one-time resources first, how could you solve the budget problem and how far could you go? So the blue bars show, well, the stacked bars show you the same cash deficit I showed you a couple of slides ago. The blue bars show you if you just shifted from pay-go to bonds, those kind of capital costs that can be shifted, that you could essentially solve the fiscal 25 budget hole that we're forecasting, and you could make some progress in each of the subsequent years. And then if you layered in using the rainy day fund, spending it down to 5%, that's the yellow bars, you can actually get through under our forecast, fiscal 27. Now, again, I'm not recommending you do that because then you leave yourselves with this huge cliff starting in fiscal 28, which is the red bars, 1.9 billion to solve. So we encourage you to think about sort of structural solutions starting in the near term to help mitigate hitting a big cliff in the longer term. So that is really the outlook on the general fund. We're going to turn now to personnel issues, and Jason Kramer is going to take over.
Thank you, David. These next two slides discuss the vacancy issue in state employment. This first chart shows all of the vacancies in by state agency across the state in the executive branch, excluding higher education. As of October of this year, there were a little over 5,400 vacant positions across the executive branch, excluding higher ed. This does factor in the several hundred new authorized positions that were added in the fiscal 2024 budget, as well as positions that have been added since then, since the enactment of the budget by the Board of Public Works. This results in a vacancy rate of 11.1%, with a budgeted turnover rate of 7.4%. Which means there will be a expected vacancy savings in fiscal 2024 of around $81 million, which Tanya mentioned earlier. This is about 1,100 fewer vacancies than there were at this time a year ago. And we can move on to the next slide. That decrease in vacancies means more filled positions. This chart shows the increase in the number of filled positions in the executive branch and the related decrease in the vacancy rate since January of this year. As I just noted, the vacancy rate's down to 11.1% in October. That's 2 percentage points lower than it was in January of this year. And there, as you can see, there are nearly 44,000 filled positions in the executive branch in October, which means there are about 2,800 more workers in state positions than there were in January of this year. And I will now turn it over to Michael Rubenstein to talk about pension costs.
Thank you, Jason. For the first time in several years, we're seeing the state's required pension contributions will increase substantially over the prior year. At the top of page 21, you can see the exhibit shows the year-over-year growth in employer contributions to the pension fund. If you look at that state total line, it shows the total projected state contributions are projected to increase by $335.8 million in fiscal 2025, a nearly 18% increase over fiscal 24. Just below that, the local contributions for the teachers combined system, which is generally paid by local school systems, increased nearly $17 million in fiscal 25, a 4.4% increase over fiscal 24. The main reason for that local contributions not increasing to the same extent as the state contributions is the state pays for the actuarial losses stemming from investment underperformance and other reasons, but the local school systems do not. There are multiple reasons for the large increase in the state's pension contributions. First, the baseline projection includes the full supplemental contribution of $75 million for fiscal 25. That was reduced to $35.2 million in fiscal 24, so it's higher in the coming year. It also includes $25 million from the pension sweeper provision, which was not included in the fiscal 24 budget. Other reasons for the substantial growth in the state pension contributions include investment underperformance, payroll growth, and inflation. Specifically, the system's investment program earned 3.1% in fiscal 23, well below the assumed rate of return of 6.8%. This brought the 5-year smooth actuarial rate, which is used to calculate the rates, to 5.5%, which is also below the 6.8%. It's important to note the underperformance relative to the assumed rate of return is due primarily to the underlying weakness in the global financial markets. The system's investment program actually exceeded its own benchmark for each of the last 3 years. Another factor is the payroll growth across all state plans grew by 8.9%, well above the 2.75% assumed rate of growth. This includes both salary increases as well as new employees. And finally, the cost of living increases for retirees grew more than was assumed due to persistent inflation. For example, nearly 25,000 retirees who have uncapped COLAs received 8% COLAs for this year. That concludes my presentation on pensions.
So Steve McCulloch is going to talk about the kind of health of the Transportation Trust Fund.
Okay, starting on page 23, the big story for the transportation program has been in the news, the media reports, is that the Consolidated Transportation Program that was submitted in September, the draft 2024 CTP, was not balanced. There was more program spending than is supported by the financial forecast. The graph at the top of page 23 kind of illustrates this problem. So the 3 bars on the left represent the revenue available to the capital program, and the 3 bars on the right represent the program capital spending, with the green bars in each of those clusters representing the January forecast came out. And as you can see, the amount available for spending for the capital roughly matches what was actually programmed. However, the blue bars represent the MDOT September forecast. And as you can see, the forecast wrote down the available revenues for capital by about $1.1 billion. But at the same time, the CTP increased programmed capital spending by $462 million. Now, this meant to indicate that this is just the 5-year period, 24 through 28, that the two forecasts overlap. But the combination of the decreased available funding and the increase in program spending results in a $1.6 billion shortfall between available revenues and program spending. Now, the red bars represents the DLS forecast, September forecast. DLS wrote down available funding by another $1.2 billion, primarily due to the fact that the DLS forecast assumes that additional operating spending is programmed to help address the WMATA fiscal cliff that occurs in fiscal 2025 and through the rest of the forecast. That increase in operating spending decreases the ability to issue debt and therefore results in that $1.2 billion. The red bar on the spending side is that amount, which compared to what is programmed in the draft CTP is a difference. The $1.6 billion grows to $2.8 billion. In fiscal 2025, which is the year that will have to be solved this coming session, the MDOT forecast had a $101 million difference or shortfall. In the DLS forecast, that increases to $511 million. Next slide. So this slide just shows the components of that $1.6 billion shortfall that in the MDOT forecast in September. It starts off with some good news. The general fund transfers into the program were increased in the September versus the January. This represents the $100 million that was provided during the 23 session for the Red Line and the Southern Maryland Rapid Transit, and the assumed $100 million transfer from the Rainy Day Fund to help support state matches for federal funds. The other $52 million in that bar represents the final contributions for the Howard Street Tunnel project from the state. Use of fund balance also was greater, and that is simply a reflection that 2023 closed out higher than the previous estimate. Moving on to the next bar becomes the negatives. Nope, sorry, still previous chart. So revenues and federal operating assistance decreased by $186 million. $121 million of that decrease represents the federal COVID assistance disappearing. There was a $121 million in 2024. There's no funding assumed in 2025 for that purpose. MDOT also increased operating spending by $942 million between the January and the September forecast. A lot of that was related to the compensation for state employees that we've been discussing in other parts of the forecast. That increase in spending on the operating side, combined with the decrease in revenues, resulted in a bonding capacity shrinking by $410 million. You layer on the additional spending of $462, and that gets to the $1.6 million shortfall. Next page. So the Spending Affordability Committee, relative to transportation, needs to make two recommendations each year. Number one, they need to make a recommendation on the ending fund balance for the trust fund, and they need to make a recommendation for the minimum expenditure level for system preservation. The MDOT forecast has a $325 million target closing balance each year. This is a needed level to accommodate cash flow, keep projects. There are many federal capital projects that operate on a reimbursable basis. So the department has to have an outlay of its own funds and wait for the reimbursement. That's the use of that, and that seems to be a reasonable level. In terms of system preservation, the chart on the middle of page 25 shows the 10-year history of spending for system preservation. The black line at the top is the 10-year average, and you can see that for fiscal 24 and 25, the estimated spending is above that 10-year average. The red line shows the percent of spending that the system preservation spending represents as a total of the total capital program in 2025 at the targeted level. It's about 37.2%. Now, MDOT has indicated that the need for state of good repair funding, and state of good repair is closely an approximation to system preservation. There is a $1.63 billion need for state of good repair funding in 2025. However, the CTP only programs $879 million. So the gap between the need and available funding grows by 751 in 2025 alone. MDOT indicates that the 10-year state of good repair funding gap grows to $11.2 billion. Next, I'll turn it over to Patrick to talk about state debt.
Yeah, hello. The next 4 slides are going to discuss the affordability of the state debt program. I'll start at the top of page 26, what we see here are the two criteria that the state uses to evaluate affordability. The first is that state debt service does not exceed 8% of state revenues, and the second is that state debt outstanding does not exceed 4% of personal income. Since last year, there have been two recommendations with respect to the amount of general obligation bonds that are authorized in the 2025 session. In last December, this committee recommended that $1.25 billion be authorized in general obligation bonds in fiscal 2025. In October of this year, the Capital Debt Affordability Committee recommended that $1.75 billion be authorized in fiscal 2025. That's a 40% increase over what was recommended by the Spending Affordability Committee. The chart at the bottom of the page shows how affordable both of those levels of authorizations are. This is done at a cash flow basis. So what that means is that this is based on how we expect the bonds to be authorized, then issued, and then what the debt service payments are going to be, or the debt outstanding is going to be. The blue lines are the CDAC recommendations, and the red lines are spending affordability. The lighter lines are the debt outstanding, which is the lower, and you can see that declines from 2.65 to 2.53 million under the CDAC proposal. And the darker lines are the debt service ratio, which declines from 6.35% to 5.9% of state revenue. So as we can see here, based on the cash flows, these both proposals are affordable. Next slide. What this slide shows is how an authorization becomes a debt service payment. The red lines, or excuse me, the red bars that you see there are the proposed authorization in excess of what spending affordability recommended. So this is the CDAC recommendation, which, as I mentioned earlier, is $500 million more than the spending affordability recommendation that you proposed last year. What the blue bars, and as you can see, the CDAC recommendation is a flat $1.75 million over the forecast period, whereas the spending affordability recommendation increases 4% annually, which is about $50 million, a little more in the out years. And that's why the red bar is getting smaller from year to year. Now, just because you authorize something doesn't mean the money gets spent right away. For example, there's planning that needs to go into projects. Lately, there's been supply chain issues and things like that. And so what the state does is it issues the bonds when the cash is needed for the capital projects. And so that means about only 30% of the funds are needed in the first year, and the other 70% are going to be needed over the next 4 years. And those blue bars show how we expect these additional authorizations to be issued based on past patterns. And the final part of this is the green line, which shows how debt service payments are going to increase over time. As you can see, there's a very long delay in that line. The first reason I already mentioned has to do with the authorizations and issuances being much later. The second factor that influences also is the state does not pay any principal until the third year. So the first two debt service payments, there's 2 years of debt service payments, are only interest payments, which means that they are quite a bit lower. And the bottom line to all of this means that if you're going to do the proposal as from this Capital Debt Affordability Committee, we expect the debt service to climb to about $250 million over time. This takes a slow growth over time, but that is kind of where you're headed. And that growth is difficult to slow down once you come in because of the delayed nature of issuances, and also the fact that we don't start paying principal until the third year. Next slide. What I do now is I take what we think the projected ratios are going to be and some of the factors that are going to influence them in the out years to get a better sense of where the capital program is headed and how affordable it is once we factor in more things than just the simple cash flow of the projects that we expect. I'll start with the blue bars there. That's the ratio that we expect under the current program as recommended by the Spending Affordability Committee. That's the $1.25 billion authorization in fiscal 2025. As you can see, there is a decline in the out years, and a lot of that decline has to do with what the last topic was about, and that is the transportation program is shrinking, and as such, there'd be less money for it, and that does help the ratios. And so, for example, the decline in the transportation program is about $930 million from fiscal 2024 to the estimate in 2029. And so that's part of the reason why those blue lines are a little bit less in the out years. Second thing I do is I add in the CDAC authorization increase, that additional $500 million in fiscal 2025. And what I'm using here is the maximum debt service. That is the level we expect to get to instead of the cash flow amount. And so what that is, that adds about a 0.5 percentage point or 51 basis points to the CDA, the Capital Debt Affordability Committee's debt service to revenues ratio. Secondly, with respect to the transportation program, just to illustrate what it would mean, if you were to only have the decline in the capital program in the out years, and say another $500 million were made available, we expect that would increase the ratios by about 0.16% or 16 basis points on top of when that's what the yellow bar is there. And finally, you expect that at least in some time in the next decade, there would be some kind of a recession. So if there were a moderate recession, that would be about another 6 or 0.16 hundredths, or excuse me, 0.16% or 16 hundredths of a percent to 2% or 0.2%, excuse me, would be added to that. And that's what that green line is there. And so when you add those things, you still have a lower trajectory with respect to the ratios that show that this higher level is affordable, but it does show you that it's almost another, but realistically, once you start factoring in these other factors, it's probably almost a whole point higher that we would expect the ratios to be. Next slide, please. Yeah, this final slide in the debts section has to do with how Maryland ranks against other AAA rated states. This is data from Moody's, who every September put out a ranking of liabilities of the states. This includes just states. The District of Columbia and territories are not included in this, so there's exactly 50 of them. What I do on the left-hand side is I show all of the states that are AAA rated from the 3 major rating agencies. Then the columns show different categories of debt, and the numbers inside show what the state is ranked compared to the other states. So a higher number means a higher debt service ranking. So if you're 50th, that means you have the lowest debt in this case, and if you're number 1, you have the highest debt. And finally, what I do is I shade all of Maryland, which I put on the top of the list, and all of the states that have higher debt than Maryland does. And as you can see from this thing, there's a couple of observations. The first is that most of the AAA rated states actually have fairly low debt. The most common groupings are in the 30s and the 40s. So the bottom, most of the AAA rated states are in the bottom 40% of debt ratios. A second thing that I've noticed too here is that, interestingly, if you look at Maryland's long-term liabilities to ratios, that's all the long-term, that would include pension, OPEB, and also the state debt. We're highest among the AAA rated states, yet interestingly, if you look at capital depreciation, where we have the second oldest capital asset stock in for state facilities among the AAA rated states. So this data does suggest that there is a lot of facilities maintenance that is part of the backlog. And so if you do increase, 40% on the CDAC ratios, that probably will push the state up a little bit on some of these ratios that will be a higher debt. So Maryland certainly is a high debt state, but we have an affordability process that manages it, and we're aware of what we're doing. And that concludes my remarks, and I'll turn it over to Emily to talk about the capital program now.
Thanks, Patrick. This slide, this graph simply shows that over the last decade, the state's general obligation bond authorization levels have grown more slowly than the pace of construction inflation, which averaged 4.5% annually over this period. For much of this time, SAC adopted a policy of 1% growth each year in the authorization level to maintain affordability. Next slide, please. This chart compares the CDAC recommended debt level of $1.75 billion to the anticipated needs of the capital program. Starting on the left, you can see that there's just over $1.2 billion in general obligation bonds programmed for fiscal 2025 and last year's CIP. And then the next two items, those are the lighter blue bars. These reflect planned pay-go general funds as well as new capital mandates. These are both included in our baseline as general funds, although the higher CDAC debt limit would allow these items to be funded with bonds instead, alleviating some of the pressure on the operating budget. After accounting for estimated inflation above what had been planned for in the CIP, a $1.75 billion limit would allow for providing an additional $46 million in school construction funding above the CIP amount, which would meet the $450 million annual commitment outlined in Chapter 32 of 2022. And then on top of that, there would be room for about $40 million in miscellaneous and legislative projects. However, you can see in the chart that legislative pre-authorizations from last session totaled $148 million, including just over $100 million in miscellaneous grant projects. In total, funding all items would require about $1.85 billion in GO bonds. And I believe that is all we have for you today, and we'd be happy to answer any questions.
Great. Thank you very much to the entire Department of Legislative Services for this very detailed briefing this afternoon. At this time, we'll take questions. I'll take questions from members of the House, and Co-Chair Roosevelt will recognize members of the Senate. And the question we have is Delegate Stephanie Smith.
Thank you, Mr. Chair. And also I want to thank all of the presenters today for all of their diligence in preparing the materials. It's pretty clear from the presentation that the federal support Maryland received was really vital, getting through the pandemic, and that gave us some flexibilities around, supplanting some of those state funds so that we could use those investments around some things I think were pretty responsible and things that I feel we probably all feel really proud of. We really figured out how we could put more investments in the blueprint, fund, more funding for the rainy day. We also looked at some of those legislative mandates that we had left unfunded that we knew we could now put some support to. And so these were all kind of a medley of really responsible choices we were making with, those federal dollars. So now that those federal funds are no longer going to be available, it's clear that we have some decisions we need to make in short order. And so when you think about the expansion of behavioral health, the investments in transportation, and of course, the infusion of capital funds that have benefited projects across, the state and all of our districts, we're looking at, based on what I could see from the general fund presentation, maybe a suite of three choices that we need to look at. The first one sounded like some type of aggressive cuts to maybe education, entitlements, or, other things like that, tapping aggressively into the rainy day fund, or maybe thirdly, I think we should, not forego a conversation about getting the resources we need in the next session to ensure that we have the funds we need in the outlying years for the big, bold commitments we've made to the people of Maryland. And so my question for Dave is, when you look at kind of those suite of options, and what would yield probably the least amount of disruption in the service, government service delivery to our constituents, what would be the least disruptive of those three choices if we're going to essentially, tap into the rainy day fund aggressively, drastically cut entitlements, education, and other spending, or look at where we can increase revenues?
It depends on how you look at it. I would say in terms of least disruptive, in terms of the programs and implementing the goals of the General Assembly with K through 12 education, for example, certainly revenue solution is probably the least disruptive because it would give you stability. You could use the rainy day fund, but you use it 1 or 2 years, and then you still have the same problem there, so you don't get the stability. So I think probably the least disruptive from a programmatic standpoint would be the revenue option. Like I said, I think the rainy day fund is the least helpful because it leaves everyone uncertain about the future, whether it's cuts or revenues.
I appreciate your answer. And again, it's not exactly raining yet, so I definitely would agree that we want to be, vigilant in that regard. Thank you, Mr. Chair, for allowing me to ask a question.
Thank you very much, Delegate Smith. Delegate Henson's recognized.
Thank you, Mr. Chairman, and thank you everyone for the presentations. I wanted to drill down a little bit on a point made by Ms. Zimmerman about the child care scholarships and a portion of that reverting in error. Ms. Zimmerman, do you have any additional information on that and any information on what we were due to make those commitments whole to the families?
So those funds specifically were from the child care stabilization funds. It was about $16 million. We are still looking into exactly kind of the situation with that, but it would depend on kind of where those commitments were in terms of how they would likely address how that would need to be addressed. But if they were commitments that already were made, they might need to bring in funding to address that, but it depends on what exactly kind of where those commitments are.
Thank you, and thank you for highlighting that in your presentation. Thank you, Mr. Chair.
Thank you very much, Delegate Henson. From the House, Delegate Watson's recognized.
Thank you, Mr. Chair. I want to thank the Legislative Services Department for the presentation and wanted to follow up on transportation with Mr. McCullough. Steve, can you explain how and why MDOT has changed the CTP draft process this year?
I can certainly explain how, but I can't explain the why. The why would have to come from MDOT. But essentially, the draft CTP released in September was the first time that program spending did not equal funds available. They kept, as I had indicated, they actually added spending compared to last January, at the same time writing down availability of revenues by $1.1 billion. So essentially, they forewent the process of matching up what they would actually put in program. And so it's one effect of that is we don't really know, what the true program or problem is, because some of that, obviously, one solution is to push projects out, and we don't know exactly, how that would be done because they, essentially haven't shown their hand on that.
Thank you. So just to clarify, you mentioned a $511 million gap for the next fiscal year, which included your estimates of what we might put in for WMATA. Is
Correct.
that right? But it does not include the governor's priority projects that he has mentioned that are not in the CTP for construction dollars.
Correct. The MDOT has indicated in the front of the CTP indicates that the draft largely reflects the prior year's administration's priorities and does not include some of the big projects that both the governor and the General Assembly have indicated they would like to see, put into the program. Now, having said that, there are some things, for example, the red line, there is planning money that went in. And a lot of the big money for the red line, for Southern Maryland Rapid Transit, that would be possibly coming in at the end of this forecast period. It might actually come in the next year beyond. So it's hard to say that they're not in because they're moving forward, but certainly there are other things that have been indicated, more immediate needs that are not in, like the American Legion Bridge, things of that nature.
Okay, correct. And last follow-up, did MDOT share how they will balance the CTP and when the public would be made aware of those decisions, since we are now in November and obviously session starts in January? Do you have any information or latest information about that?
Well, so the department is, pointed to the Train Commission, which is currently meeting this interim. It's a 2-year commission, so it will continue its work next year. I believe they were hopeful that there would be recommendations for some revenue increases that might be considered in the 2024 session. So that process is still ongoing. The Train Commission has a meeting in December to discuss its recommendations, but my sense is it's not going to be, there's not going to be recommendations from that body forthcoming that would be sufficient to actually, solve this issue without some reductions to the programmed capital spending. The next kind of point in the forecast period comes in January, when at the same time that the budget is required to be submitted to the General Assembly, MDOT has to submit the capital CTP and their forecast that backs that up. So really, they are in the process of doing that. In the fall, this time of year, they are looking at the revenue estimates, continuing to refine that, and continuing to work with the administration on what the administration's priorities will be to be actually put into the CTP. I wouldn't expect, and I did listen to your subcommittee's hearing the other day and the plea that it be done sooner. There's not a lot of opportunity to rush that project. I mean, they're working as fast as they can. Generally, we often ask them for whatever advanced information we can get to prepare for our briefings in the session, and they're working right up till that deadline to massage that. So unfortunately, I think that we're going to wait to see the final draft CTP, or the final CTP in January, supported by the forecast. So at that point, we'll know how they propose to solve the problem.
Thank you. Just to note on what you said is typically they present a balanced budget. So
correct.
We understand they're working as fast as they can, but the fact is they gave us an unbalanced budget, and we have localities that may need or will need notification if their projects are going to be cut or delayed. So thank you, Mr. Chair.
Great. Thank you very much, Delegate Watson. From the House, Delegate Solomon's recognized.
Thank you, Mr. Chair, and thank you again to all the presenters for today's presentation. I had a couple of questions for you, Jason, on the personnel side, and I really appreciate the chart on page 20, because I think it shows that although the vacancy rate is decreasing, part of the reason we still have a vacancy rate is that we've been able to fill a lot of it is we've created new positions. And obviously that's really important, but making sure that we're really honing in on the positions that were vacant prior to the new mandates, gets to the point I think that we've discussed a lot, particularly over the last year, of making sure that current state employees are doing the jobs that they were hired to do, that we're able to, to satisfy the basic needs of state government. Just kind of curious, do you know what is the quickest, the largest decrease, I guess, in a vacancy rate that we've ever had in 1 year? And do you have any sense of historically, within maybe the last 10 or 20 years, what's the lowest the vacancy rate in state government has been?
I don't know if I can answer the quickest decline, but I can tell you the lowest the vacancy rate has been was in the last 20 to 25 years was in April of 2009. When the vacancy rate was about 4.7%, which is less than half of what the rate is today.
Thank you. And do you have any sense of, were there any specific agencies in your analysis over the last year that really saw a decrease in vacancy rates?
Yeah, so there's a couple of agencies that have seen some pretty big improvements. The Department of Agriculture specifically has dropped from a vacancy rate of nearly 15% down to 6.5%, which is the lowest vacancy rate in the state. DJS and MSDE and other education agencies, while they still have fairly high vacancy rates, around 10 to 11%, have seen a 5 to 6 percentage point drop in their vacancy rates. So those are two agencies that are making significant progress in the last year or so.
Thank you. And I know that was a huge priority, obviously, for our speaker in highlighting and really lifting up the vacancy rate. And obviously, as was mentioned, the general fund spending increase is due to the cost in personnel. And obviously, we're going to need to find a way to continue to fund and support these type of costs if we're truly committed to rebuilding state government. So I really appreciate your work, and thank you, Mr. Chair.
Thank you, Delegate Solomon. Are there any other questions from members of the House or Senate or Department of Legislative Services?
Are there any questions from members of the Senate at all? Well, I'll ask one question, then maybe I'll stimulate some other questions if anybody have them. I want to go back to Dave Roman's. The chart where you showed the structural deficit out to, I think, 2028. Is that the last year you have on there?
29.
2029. As we know, the blueprint funding scales up. When does it level off? And how much more will that structural deficit be when you get out past the 30, 31, et cetera, before it levels off?
Yeah, so the blueprint keeps getting implemented through 2034. It probably grows in the 400 million-ish range a year from 2029 to 2034. So that blueprint chart I showed, I had the green bar for what the general fund costs would be. By 2034, it'd be like 4.2 billion that the general fund would be paying for blueprint costs.
Great, thank you. Any other questions? Going once, going twice? Back to you, Chairman Chang.
Great. Thank you very much, Chair Rosapap. On behalf of the Spending Affordability Committee and Co-Chair Rosapap, we just want to thank everyone for being part of today's presentation. And with the Thanksgiving season around the corner, we just wish everyone a happy Thanksgiving. And the next meeting for the Spending Affordability Committee will be on December 14th at 4 p.m. And it will be in the House Appropriations Committee room at 120 in the House Office Building. Thank you very much. Have a great day.